Over the past 1,300 days, I've been in a poor man's covered call and TQQQ. During that time, the stock has gone way down in price, and then it reversed and has gone way up in price. And for that entire roller coaster, I've been in this poor man's covered call and TQQQ. This video isn't theory, it's my actual experience trading in TQQQ over the past 3.5 years using a poor man's covered call. But what you probably wouldn't expect is that a strategy I used inside this poor man's covered call trade actually yielded a 3,300% return. And it's probably not the one you're thinking of. In just a minute, I'm going to show you how I set up my poor man's covered call. But first, why did I decide to trade a poor man's covered call in a 3x leverage ETF TQQQ? There were several reasons for that. The first is that leveraged time decay because it's a 3x levered ETF. The second was the volatility crush that I'd be able to benefit from if TQQQ experienced a volatility spike. As you can imagine, over the past 1,300 days, we've had multiple volatility spikes. And finally, it gave me the opportunity to benefit in a leveraged way to some theta decay, as well as gamma opportunities. Now, I know that might be a foreign word to you, but I think you'll understand once I show you this entire trade. A little later in the video, I'm going to show you what happened during the 2022 crash with my TQQQ position, because TQQQ actually crashed about 80% during that time. So I'm going to show you how the position fared during that time. But now let me show you how I built my poor man's covered call position in TQQQ. Here you see a long-term chart of TQQQ, and this is the weekly chart. In the box here, that's the time frame that we were in this poor man's covered call in TQQQ. Now initially it started out as a covered call and not a poor man's covered call because I was assigned some put options that I've been selling. Let me give you the details of what these various lines mean. During the time frame of this thin teal line, that's when I had allowed some put options to be assigned to me, and I've been selling covered calls against it. So as you see here, on May 4th of 2022, I was assigned TQQQ at $52 per share. And fast forward about 9 months later, and on February 3rd of 2023, I allowed those shares to be called away from me. And just before that, on January 9th of 2023, I started my poor man's covered call by buying a LEAPS call option in TQQQ. And on that date, January 9th of 23, I bought the option that expired about 2 years in the future. I bought the January of 2025 call option. And I bought that $40 strike price call option. Now at that time, TQQQ was trading pretty far out of the money from that call option. In fact, it was trading for about half of that $40 strike price call option I bought because it was trading for around $22 to $25 per share. But I felt pretty confident that TQQQ had probably bottomed out from its recent decline in price. So although I owned some shares of TQQQ during the crash of 2022, I switched over to a poor man's covered call in early 2023. Now, generally speaking, when I buy a LEAPS call option, I want to buy around the 70 delta call. Now, I will adjust that depending on my expectation of what the market's going to do, but as a general statement, I like to buy around that 70 delta call option. However, if I think the market is most likely going up, then I am open to buying a higher delta call option. That way I benefit from the appreciation of that option if the stock goes up in price. However, if I think that we might be topping out, and I'll get to that a little bit later in this video, then I might buy a lower delta call. That way it's not hurt as much if the stock goes against it. But generally speaking, I'll buy around a 70 delta call. My thinking behind buying this out of the money call option is I felt pretty sure we were going to go up in price, and I thought it would be a pretty sharp increase in price. So I believe that even though the call option was out of the money, I would still benefit from stock price appreciation. I'm going to show you that in just a minute. But one thing to note by buying that out of the money call option, and my strong belief that TQQQ is about to reverse and go up in price, it gave me a tremendous amount of leverage. Remember I mentioned to you that I had a 3,300% return in part of this position? That out of the money LEAPS call option I bought was part of the reason why. A little bit later in this video, I'm going to answer the question, was it worth it? Was it worth tying up my money for 3.5 years? Was it worth doing trades in TQQQ for 3.5 years? Because it is a roller coaster ride. But now let me show you the real numbers of what happened to my covered call and poor man's covered call position in TQQQ during the 2022 crash. Now if I zoom out here, you see that during that time, TQQQ crashed about 80%. I mean, it was a huge crash. It went from around $90 per share all the way down to about $16 per share. That's painful. But what happened to my position during that time? Here you see an Excel spreadsheet that contains all my poor man's covered call trades that I did during the past 3.5 years in TQQQ. Now you're going to see some blanks up here. That's where I was selling some cash secure put options. And in my next video, I'm going to talk you through how that played out. But in this video, we're just focusing on the poor man's covered call portion of TQQQ here over the past 3.5 years. So I want to show you what happened during that 2022 market crash, and those trades are in this pink or light reddish color shaded area. Now remember, selling call options started out by me being assigned some shares, and I was selling some covered calls against them. And notice over here my cash so far in this column. As you can see here, it was negative to begin with, but then it slowly began to climb. And here you see in these two columns the dates. This column here is the date I sold the call options, and this column here is the date that I bought the call options. Now for the most part, we're selling short near-term call options, and about once a year, I'd buy or roll that LEAPS call option, thus making it a poor man's covered call. But notice this far right column, cash so far. How bad did it get? I've been trading short call options in TQQQ starting back on March 15th of 22. And that position did go negative by about $1,800. But then my profit began to climb. As we scroll down here, we're progressing through 2022. And notice that at the worst of it, after trading it for about 5 months, I only made about $211. I mean, that was a lot of work for $211, and I had money at risk. So it wasn't just time, it was also money at risk. But then I shifted my strategy a little bit, as you're gonna see here, and our profit began to climb in this position. And it climbed to the point that by early 2023, in fact, January 3rd of 23, we were showing a profit of about $5,900 in just the poor man's and covered call portion of this position. Now, up until the end of 2022 and early 23, those are pretty much all covered call trades. But then I allowed the stock to be called away from me, and actually took a loss on that stock. But at that point, I switched to a pure poor man's cover call. No more cover calls, just poor man's cover calls. And here's what happened. So notice in this column here that I bought my first LEAPS call option against TQQQ on March 9th of 23. So that's a little over 2.5 years ago. Where was TQQQ trading at? Was trading for around $17 per share. And I actually picked the bottom pretty good. I mean, it almost is the bottom to the week. Now I will say there was some technical analysis in there, and actually I'm going to show you what I was looking at when I did this trade. Because typically, this is a spot where traders, they give up. I mean, they're showing losses or they've worked really hard and pretty much made no money. But I felt pretty confident that if I stuck with my strategy, I would win long term. But here's what the chart looked like. It didn't look great, but I believe at some point we're going to bottom out. I mean, this is based on QQQ. That index isn't going to zero. But the problem with the leverage ETF is that it can go down a lot more than the underlying ETF. Remember, it's a 3x levered ETF. All right, so here's where we're at. It's January 9th of 2023. And I've just bought the $40 strike price call option that expires 2 years into the future. Notice what I paid for. Because it was out of the money, I only paid $3.04 per share. And then fast forward about 14 months later, you see that on March 13th of 2024, I sold that call option for $25.66. That's a tremendous return. I made over $22 per share on that LEAPS call option. And notice all these blank spaces in here. That's where I sold put options. Notice what didn't happen. I didn't sell a single short-term call option against the LEAPS call option I own. So basically, I didn't do a poor man's cover call during that time. I simply bought a LEAPS call option, was looking for TQQQ to go up in price. And that's exactly what happened. During that time, TQQQ went up by about 235%. With my belief that we're probably going to bottom out pretty soon, since I believe that we're probably reaching a bottom down here in January, I didn't sell those near short-term call options against it because I wanted to get full benefit from stock price appreciation. As you saw, we got tremendous benefit, and part of that was leverage. We bought that out of the money call option, and it went way up in price. And just note here that on February 17th of 23, I bought a second LEAPS call option that was out of the money. Then fast forward about 13 months, and on March 13th of 24, I sold that call option. And actually what it is, I rolled it here. But that was the $45 strike price call option. And again, notice that I paid $3.57 per share for it. And then when I sold it for $22.05. So again, another big win on this. I was expecting the stock to go up in price, and it did exactly that. Now remember, we bought those longer term LEAPS call options in January and February of 23. Now fast forward several months, you see that in July, I turned them into a poor man's cover call. And I'll show you why in just a minute. So remember, I owned the $40 and $45 strike price call options. And on July 5th of 23, I sold the next month call option at a $50 strike price. So we began to collect some nice premium by turning these longer term LEAPS call options into a poor man's cover call. In fact, for that one, I collected 61 cents per share. And when I bought it back about a month later, it only cost me 3 cents per share. Now, I'm not going to go through every trade in this video, but just keep in mind that I bought that $40 strike price call option as represented by this thick teal line here. And this date here around July 5th of 23, that's when I sold the $50 strike price call option. So still pretty far out of the money. We had really just experienced a nice run up in price. You see, I was thinking we're probably going to stall And that's exactly what we did. Notice that we just kind of stalled and went sideways for several months here. All right, so we've now turned this position into a true poor man's covered call. We own a LEAPS or longer term call option. We're selling short near-term call options against it. And generally those short near-term call options, I want them to be at most in the money a little bit, but preferably out of the money if I'm bullish, or if I'm bearish and think the market might go down, I'm okay with them being in the money by a pretty good amount. And I'm selling around the 30 to 60 day expiration call options. Now, if I need to collect more premium to help rolling the short call option up, then I may go out as far as 90 days. But generally, I was trying to sell a 30-day option at most 90 days. And here you see we rolled those short near-term call options over and over again. Here's one that we sold on August 9th. We bought it back on September 15th. Notice we collected 24 cents per share and we let it expire worthless. And we weren't collecting much, as you see here. And some of the time we didn't collect a whole lot. We collected 24 cents per share there, 19% there, and it cost us 4 cents to buy it back. We collected 28 cents, it cost a penny to buy it back. 29 cents, it cost us 2 cents to buy it back. So overall, we're collecting nice premium. But then notice what happened here. On November 11th of 23, we sold another near-term short call option and got 62 cents per share. Well, then TQQQ went way up in price. And here you see the chart during that time. This is the week we sold that call option. Here's when we rolled it. Notice that it went up 35% in just that 2-week time frame. So yes, we did show a loss on this one. As you see here, it showed a loss of $736. But remember, we own that longer term LEAPS call option, that while this is showing a loss, that longer term call option, it would actually show a gain. And remember that gain? It was a pretty good gain, as you saw here. We bought them for $3.57 and $3 and sold them for $22 and $25. So although we lost a little money on that short near-term call option, in fact, $736, we gained on the longer LEAPS call option. And then you see several more trades we bought and sold those short near-term call options. And for several months in a row, we actually lost money on those short near-term call options. We'd have to pay more for them when we bought them back than we received when we sold them. Now remember, we have that long LEAPS call option that's gaining value as the stock goes up. And that helps to offset the losses on the short call options that we're selling that have a near-term expiration. Then notice this line here in blue. This is when I rolled that longer term call option. Remember, we owned the $40 and $45 strike price call option? Well, because TQQQ had gone up in price, I decided to roll my strike price on those LEAPS call options. So this is the approximate date when I rolled my LEAPS or longer term call options that I owned. Notice on that date, TQQQ was trading for around $59 per share. I still felt bullish on the stock, so I wanted to roll my strike price up as I rolled it out, but not too far up. So here you see represented by this thicker teal line, this is the $40 strike price that I sold, and here was the strike price of the one that I bought. They were at $55 per share. So still pretty close to at the money. By being at the money, it allowed me to benefit from stock price appreciation, but the stock crashed, I wouldn't get punished too bad as compared to if I own a deep in the money LEAPS call option. Well, how'd that play out? Well, first, let me tell you what happened during the next year. Now, first of all, remember that we rolled our LEAPS call option on March 13th of 24, and we sold it in April of 25. And we actually had a pretty big loss on that LEAPS call option. So whereas we had done really good on the LEAPS call options that we bought before, on these we ended up losing pretty good money. Notice it cost us $21.63 to buy it, and we ended up selling it in April of 25. We only sold it for $4.43 per share. Now, why was that? Well, during that time frame, although TQQQ went up most of the time, in February, March, and April of 25, it crashed. It crashed nearly 70% during that time. So what did our profit and loss look like? Well, here you see the low of that profit and loss. During that time frame, when we were in the LEAPS call options that we bought in March of 24 and sold in April of 25, our lowest point is in this overall poor man's covered call position. We only showed a profit of $1,983. That means we were in a covered call, poor man's covered call, and TQQQ for over 2 years. We did all that work, had all that money at risk. We only showed a profit of $1,983. And before I show you the final results and where we're at as of this moment, I want to point a couple things out to you because it'll help you make a decision if you should do a poor man's cover call in a leveraged ETF like TQQQ. If you're going to trade in a 3x leveraged ETF and do a poor man's cover call in it, just know these 3 points. You're going to have times when you're showing losses. You're going to have times where even if you manage it properly, things happen that surprise the market and probably surprise you. So you're going to have some negative trades possibly early on. But if you structured it right, if you use the correct deltas, you reposition the strike prices of your long calls and your short calls properly, then in the end it can be a winning strategy, as you're going to see in just a minute. But just know that occasionally you're going to have deep drawdowns as we're experiencing right here in April of 2025. And if you like roller coasters, trading a poor man's cover call in a 3x leveraged ETF, well, it might just be the thing for you. But you have to trade them properly because if you don't, you can lose all your money. In fact, it can go negative on you if you don't trade them properly. But just know that even a winning strategy, which this one has ended up being a win for us, I'll show you that prop in just a minute, but even a winning strategy has times where it's going to be down. And sometimes that pain can be pretty big, or those losses can be pretty big. Or maybe you made a bunch of profit and it ate up almost all those profits, as you saw in my spreadsheet. But by having a well-designed, well thought out, and properly managed performance cover call, they can be very profitable. And here's my winning strategy, my winning formula for trading a poor man's cover call and high leverage ETFs. Notice that I didn't just sell calls. Remember when I was very bullish on the stock, I bought a long-term LEAPS call option and then just let it sit out there. I didn't sell any near-term call options against it. In fact, I didn't begin to sell those near short-term call options until I thought the stock might be leveling off. So I benefited from that whole ride up and didn't give away any upside. And then when the stock began to level off and I began to sell those short near-term call options against it, I rolled them out and positioned them properly. I positioned them where I thought the stock might be over the next 30, 60, or 90 days. And I positioned them in a way that my long-term LEAPS call options, they'd be able to benefit from that run up in stock. I could still pocket some premium by selling the call options, and I wouldn't miss out on a lot of the gains. When I was bullish, I tried to either sell those near-term call options out of the money or in the money by a little bit. And when I was bearish, I didn't mind selling them in the money to give me some cushion in case the stock did come down in price. And during that whole time, I was managing the risk of assignment. You see, if those cover calls went in the money, I was watching the extrinsic value to avoid me being assigned call options on a position I didn't own the stock. Remember, I owned a LEAPS call option. I wasn't doing a cover call. So I managed my risk properly. It's not that hard once you know how to do it. That helped me avoid having to deal with call options that were assigned. As you see, during this 3.5 years, I was in this cover call and poor man's cover call and TQQQ. TQQQ was all over the place. It went way up in price, went way down in price, went way back up in price. So the direction, although it was important, it wasn't the most important part. The secret to winning was in my management. I managed the position properly. You see, winning comes from having a good plan and then sticking to your plan. In just a minute, I'm going to answer the question, would I do this again? But first, let me show you where we're at as of this moment. Now, today is November 13th of 2025, and this is where the position sits right now. This is just my poor man's cover call and TQQQ, my profit and loss for trading it over the past 3.5 years. Here in this green line in the yellow box, that's my long LEAPS call option. Notice that I bought it for $8.13 per share, and when the market closed last night, it was trading for around $63.75 per share. And I'm currently short the third Friday of November, $105 call option. I sold that call option for $5.08 per share, and as of the close of the stock market last night, it was trading for around $8.48 per share. But for all these cover call and poor man's cover call trades I've done over the past 3.5 years, I have a profit right at $12,636. As you saw, most of our profit came from those longer term LEAPS call options that we own. And that makes sense because TQQQ went way up in price during the time we were trading this. But it also at times went way down in price. So selling those short near-term call options against the longer LEAPS call options, they help cushion the position during those losing time frames. In the end, what was my edge? Well, it was time, it was leverage, and it was technical analysis. That allowed me to position my poor man's cover call and adjust it on a monthly basis if need be to turn it into a very profitable trade. So would I ever do this again? Well, the answer is yes. I plan to keep running this indefinitely. In fact, I'm probably going to adjust my LEAPS call option today. Although it's been a roller coaster during the past 3.5 years, it's overall been a very profitable position for me. So let me ask you, have you done a poor man's cover call? If so, have you done a poor man's cover call in a leveraged ETF like TQQQ? And how did it go for you? Let me know down in the comment section below. If you'd like to get an alert whenever I buy stock or sell options, like the position I share with you in this video, check out the benefits of becoming a patron down at the link in the description below. One of the biggest fears that poor man's cover call traders face is being assigned stock that they don't own. If you're ever worried about early assignment, check out the video at the link above and the description below entitled The Truth About Option Assignments Insider Secrets. Until next time, happy investing, and we'll see you again soon.